Hello everyone, welcome to BISP Solutions. BISP Solution is a tech company that provides technical solutions across the world. So today we will be having our webinar on financial modeling. So today we will be learning about the basics of financial modeling, and in our previous session we have covered our financial statements, how to prepare it, and what data we have to take from internet. And now we will be using ratio analysis for analyzing our financial statements and also analyzing our health of our company, so with different ratios. So starting with the financial statement which we have made in our previous session by taking data from screener.in, and we have analyzed the data, and we have used formulas for calculating income statement or the elements for cash flow statement and balance sheet. So we have prepared financial statements for a company we have taken as Eicher Motors. Now moving forward, so today's ratio, we will be understanding types of ratio and example of ratio analysis by taking company's data we will be taking. So first of all, what is ratio analysis? Ratio analysis is a way to understand the performance and health of a business using numbers from its financial statements like balance sheet and income statement. So it is a fundamental tool in financial modeling that serves various purposes by providing insights into the financial health and performance of a business. Then comes our why we do ratio analysis. For understanding financial performance, it means the ratio highlights strengths, weaknesses, and trends in financial results. Then benchmarking, it means ratio allows comparison with industry peers or historical performances. Next is our decision making, which helps stakeholders making informed decisions regarding investments, management strategies, and resource allocation. Forecasting, it aids in projecting future performance based on past data. And risk assessment, which identifies areas of concern such as liquidity issues, financial instability, or insufficiency. Next comes our how it helps in financial modeling to us. So it identifies strength and weakness, and it helps in comparing with competitors or industry benchmarks, and it tracks performance over the time, and also it supports decision making for investment, credit, or in management strategy. So it acts like a health checkup. Just as doctors use blood pressure or heart rate, we use financial ratios to check business health. Next is our key financial ratios and their indicators. So first is our profitability ratios, which measure how well the company converts revenue into the profit. For example, gross profit margin we take, net profit margin we take, and return on equity, which is ROE, we take. So these tell us if the business model is working and if the company is truly making money or not. Next comes our liquidity ratios, which means measuring the company's ability to pay short-term obligation. For example, current ratio and quick ratio comes under liquidity ratios. So if these ratios are too low, the company may struggle to pay its bills on the time. Then comes our solvency ratio, which means leverage ratio. So the purpose of solvency ratio is to assess long-term financial stability and debt risk. For example, debt to equity ratio comes under solvency ratio, interest coverage ratio comes in under solvency ratio only. So too much debt, it's risky. A healthy solvency ratio shows the company isn't overburdened with loans. Next comes our efficiency ratio, which means activity ratios. So it shows how well the company uses its resources. For example, inventory turnover ratio, debtor turnover ratio comes under efficiency ratios only. So if inventory sits too long or customers delay payments, efficiency ratio reveals the issue. Then comes our valuation ratios, which means for investors it is calculated. So the purpose is to measure market value compared to financial performance. So price to earning ratio and earnings per share comes under this valuation ratios only. So investors use these decide indicating if the company stock is overvalued or undervalued. Next comes are how it affects the company. So ratios help in both internal decision and external decision. So internally, managers use ratios to identify issues early, like falling margins or rising debt. Next comes is externally, where banks, investors, and analysts judge the company based on its financial ratio. So, which means if the ratio is bad, then loss of investor confidence, and good ratio is there, then better credit, investor trust, and market valuation will be done. Next comes are by analyzing ratios, we can gain operational efficiency, which means insights into how effectively resources are utilized, financial stability, which means understanding of liquidity and solvency, profitability trends, which means areas of growth or decline in profits, investor appeal, which is whether the company is attractive to investors based on market ratios, and strategic focus, which means data driven strategies to address weakness or capitalize on strengths. So in financial modeling, these ratios act as check and balances, so it ensures that our projections are both reasonable and actionable. Next comes are how to tell if company is financially healthy. So high and stable profit margin is there, then healthy liquidity ratio above 1 is there, and low debt ratios and high interest coverage is there, and fast inventory turnover ratio, short debtor days, positive and strong cash flow ratios, and competitive ROE and ROCE. So if we take a case study of Veggie Bites Food Limited, so it is a company which operates as a food manufacturing business. Veggie Bites is looking to expand its operations and seeking financing to evaluate their financial health and performance. So Veggie Bite Food conducts a ratio analysis to present a convincing case to investors and lenders. So they have calculated liquidity ratio, where ratios will be calculated as current ratio, quick ratio, and cash ratio. So it determines short-term financial stability. So liquidity ratio assesses the company's stability to meet short-term obligations. So for Veggie Bites, this helps ensures they can pay suppliers and manage operations without cash flow interruption. So current ratio is calculated by dividing current assets by current liabilities, and a healthy ratio above 1 indicates they can cover short-term liabilities. Then quick ratio excluding inventory assures stakeholders that Veggie Bites has liquid assets available if inventory sales slowed down. So the benefit of liquidity ratio is investors feel confident about Veggie Bites operational stability, reducing the perceived risk of lending. Next is our profitability ratio, where ratio is calculated by net profit margin, return on assets, and return on equity, and it is for operational efficiency and earnings generation. So profitability ratios determine how effectively Veggie Bites Food generates profits from revenue or assets. So Veggie Bites net profit margin, where it is calculated as net income divided by revenue, reveals how much profit is made for every dollar of revenue. So if Veggie Bites Foods has a margin of 15%, let's suppose, so it indicates sound cost management. The ROA assesses how effectively Veggie Bites Foods utilizes its assets to generate profit, while ROE highlights returns generated for shareholders. So the benefit for profitability ratio is the company uses profitability ratio to show how their efficient operations maximize shareholders' value, appealing to equity investor. Then comes our leverage ratio, where we will be calculating debt to equity ratio and interest coverage ratio, and it is for financial risk and capital structure calculation. So leverage ratios evaluate how Veggie Bite Food balances debt and equity financing and its ability to manage debt obligations. So let's suppose debt to equity ratio, if they want to calculate, it compares total liabilities to shareholders equity. So if Veggie Bite Food has a ratio of 0.5, so it means debt levels are lower than equity, which showcase prudent financial management. And if we calculate interest coverage ratio, it will be calculated as EBIT divided by interest expenses, which demonstrates Vegemite Foods' ability to cover interest payments and reassuring lenders about its financial resilience. So the benefit of leverage ratio is these ratios bolster confidence among lenders that Vegemite Foods can sustain growth without excessive financial health. Then comes our efficiency ratio, where we will be calculating ratios from inventory turnover, asset turnover, accounts receivable turnover. So the use of efficiency ratio is for resource utilization and operational efficiency. So efficiency ratios measure Vegemite Foods' ability to effectively utilize resources and manage processes. So for example, if we are calculating inventory turnover ratio, so for that we will be dividing cost of goods sold divided by average inventory, which indicates how often inventory is sold and replaced. So higher the turnover reflects robust demand and efficient inventory management. And asset turnover gauges, which means Vegemite's food ability to use assets like factories and equipment to generate sales. So what will be the benefit of efficiency ratio? So these help Vegebites optimize operations, reduce cost, and boost profitability, which attracts investors seeking operational excellence. Last is our market ratio, where we will be calculating price to earning ratio and dividend yield. So it is calculated to value our market valuation and investor returns. So it market ratio is to calculate our market valuation and also investor funds or investors return. So market ratios are essential for Vegemite's food if they are publicly trading or planning an IPO. So these ratios highlight the stock's attractiveness to investors. So let's suppose if Vegemite is calculating PE ratio, which is market price per share divided by earning per share, which reflects investor sentiment and growth expectation. So lower ratio might attract value focused investors, and dividend yield showcases the return investors get via dividends related to the share price. So the benefit is market ratios elevate Vegebites Foods appeal to retail and institutional investors by showcasing its stock performance and shareholders' return. So, what will be the outcome of ratio analysis? So, by these ratios analysis, Vegemite Foods proves short-term liquidity to suppliers and creditors, demonstrates robust profitability to equity investors, and highlights manageable financial risk to lenders, and optimizes operational efficiency for long-term sustainability, and enhances market attractiveness to shareholders. Now, we will be taking real company data, how these ratios work. So we will be going to our Excel sheet where we will be calculating our ratios. So in my previous session I have calculated my income statement and balance sheet and cash flow statement by some calculation I have done by linking data to my individual heads, and some data I have calculated so that I get desired result. So I have done formatting also, and if I want to check my total liabilities is equals to total assets, so I have taken a formula where I have given formula as equals to total assets is equals to total liabilities, and when I click on enter it will be showing me true option, and I have dragged it till the March 24. Like same we have done for every statement we have prepared. Now coming to our ratio analysis, what I will be doing now, I have given different ratio analysis and their meaning, why we are calculating it. So this growth ratios for growth ratio analysis. So what we will be doing, we will be linking it again with our historical financial statements. So sales growth we have calculated over here and done. Control plus C and till 24. We will be now what we'll be doing, percentage we will be converting it, and for EBITDA growth we will be doing if error function. And now what we'll be doing, we will be coming down, we will be dividing March 16 data from December 14 with -1 and 0, done. Control plus C and dragging it till the end. So what we will be doing, cut copy paste thing, but not for that. Control Alt and V, and we want only format to be pasted. It is showing some 100%. Again we will be calculating it. EBITDA -1 and 0, done. So for EBIT growth, what we'll be doing, again if error function, then coming to our historical financial statement, we will be taking our EBT of March 16 divided by December 14 -1 and 0, and that is done. Firstly we will be calculating all the ratios for 1 year. If error, net profit growth it is asking us, so for that again net profit upon this -1 and 0, done. Whatever we will be now entering, it will be coming under percentage only. Now dividend growth, if error, so dividend we will be dividing March 16 data from our December 14 -1 and 0, and done. So now we will be selecting this, Control plus C and V. So Why it is showing me 100? Because LTM is not having data over here, so that's why it is showing me 100%. So let's suppose we will do one thing. We can do it as dash and right alignment. This is also same as this. Now this is what our growth was about. Now I have to calculate my gross margin, where we will be calculating our margin ratio analysis. Again, what we will be doing, gross margin, if I want to calculate, I will be linking it with my historical, because I have already calculated it in my financial statements. Now we will do our formatting afterwards also, we can do that. Then for our EBITDA margin, what we will be doing, again going to our historical financial statement, and we have already calculated our EBITDA margin. Then EBIT margin we have to calculate. So for that, what we'll be doing, again if error function, and we will be going to our historical financial statement, then EBITDA of March 16 divided by first we will be subtracting our depreciation and dividing our sales, and then 0 and done. So it is showing me different things. So now what I will be doing, I will be giving two brackets over here, and one is closing over here, and another one will be starting from here and closing. Again we can type this. So for EBIT margin, we will be taking our EBITDA of December 14 minus, we will be deducting our depreciation. This is done. Then we will be dividing our sales and 0. So okay, so it is showing me few arguments are there, so I will be taking this also. So now it is taking many arguments, so we can do one thing, we will just click on equals to EBITDA minus depreciation. It is under bracket. Okay, just a second, I just entered it, clicked on entered, so that my answer is coming like that, EBITDA minus depreciation. Before clicking on enter, what I will be doing, I will be closing this bracket, and then I will be dividing it by my sales, and done. So this is my EBIT margin. EBT margin we have to calculate, so equals to, if error again, then we will be taking our linking it with this and 0, because we have already calculated it. Now net profit margin, we have already calculated it, so it is not showing me this and 0. Now what I will be doing, I will be selecting this data, control plus C, and dragging it till the March 2023. Now converting all of them in percentage, no, sorry, just a second, percentage and 2 decimal places, and again this will be like this only. Now just a second, I have to make it freeze. Now if I want to calculate my sales expenses percentage of sales, so it is in context with sales ratio. All the ratios we will be calculating now is in relation with our sales. Okay, so what we will be doing, again if error function we will be using, then we will be going to our historical financial statement, where we will be taking it our SNG and 0. Done. Depreciation percentage of sales, we have already calculated it. We just have to do linking it with our financial statements, all the things. That's why we have calculated, and I have already told you all that it will make our work easy once we have calculated in our financial statements. Then operating income we have to take. So what we will be doing, we will be taking our EBIT margin, because it is having our calculation, and I haven't used my if error function because this EBIT margin or EBT margin is having the calculation and if error function itself. So pasting it. Now coming to our employed, which is return on capital employed, which is for health of the company, we can get from the ratio analysis. Again we will be doing if error function, and now we have to calculate our return on capital employed. So for that we will be doing EBITDA. Just a second, we will be calculating it now. So EBITDA, EBITDA of December 14 minus our depreciation, closing bracket, then divided by sum, where we will be taking our equity share capital till our other liabilities, and this 0 and complete it. We just do one thing. If error function we have already applied in our financial statement, we can just easily link it with our financial statement. Again EBITDA minus depreciation of December 14 closed, divided by sum of our equity share capital to our other liabilities, closing the same. So this is what our return on capital employed. Then retained earnings, we will be linking it with our financial statements where we have calculated over here. Now done. Now return on equity, so we will be taking our net profit for December 14, which will be divided by our sum of equity share capital and reserves. And our okay, now equals to self-sustained growth rate, which is our retained earning percentage, into return on equity. Completed. And return interest coverage ratio we have to calculate. So for that, what we will be doing, we will be linking it with our historical financial statement. For that, EBITDA minus our depreciation divided by our interest and enter the same. So again, what I have to do, I have to give bracket here and here also. Removing bracket from this side. Okay, so we get our data like this. Now what we have to do, Control plus C, and selecting these two, and Control Alt and V, we have to format, we have to copy our format only. So it is showing us this. So before doing that, we can undo it firstly. Control plus C and dragging it till the March 23. Now coming to our turnover ratios, where we will be calculating our turnover ratios, where working capital turnover ratio we will be calculating. So we will be linking it with our sales divided by our receivables, and done. Then for creditor turnover ratio, we will be linking it with our, we can link it with this data sheet also, sales divided by other liabilities, and done. Equals to, for inventory turnover ratio, we will be doing our sales, not this sales, this sales divided by our inventory, then fixed assets turnover ratio, again our sales divided by our fixed assets net block. So this is our, okay, now equals to capital turnover ratio, where we will be taking our sales divided by sum where we will be taking sum of equity share capital, over here it is, and our reserves. Done. Now these ratios we will be converting them in X, like control plus 1 number custom. In my previous lecture I have already told you all how to put our X in front of our numbers, like this, control plus C, and it will be copying the end. Now we have to calculate our debtor days. So if error, no, not required, because we have already calculated it in our financial statement. So for debtor days we will be calculating it by 365 divided by our debtor turnover ratio, then enter the same. Again, payable days, so for that we will be giving 365 divided by creditor turnover ratio, and done. Equals to inventory turnover ratio, we will be selecting 365 divided by our inventory turnover ratio, and done. Then again, cash conversion cycle. So what we will be doing, we will be doing sum of debtor days, inventory days, and then we will be deducting our payable days, and like this, control plus C and dragging it till the end. Now what we'll be doing, control plus C, and we will be pasting the same format over here, control alt plus V, format we want, and with 2 decimal value, like this. Now if I want to calculate my CFO upon sales, so again we will be going to our historical financial statement, linking it with our cash flow from financing activities. So for that we will be taking our total cash flow divided by our sales, which is this, and done. Equals to again total assets, historical function, and we will be taking our total assets divided by from sales, and done. Equals to total debt we have to calculate. So again what we'll be doing, CFO divided by our borrowings. So borrowings is in data sheet, so we will be taking from here. Now same thing, control plus C and dragging it till the end. Now copying the format over here, control alt and V, format, copy. So this is how we make our ratio analysis in our Excel sheet. Now moving forward, if we want to make our trend, so what we have to do, we have to go to our insert option, then we get the spark lines option, then we will be clicking on line. So data range it is asking us, or we can do one thing, we can just do a little bit of formatting over here. We can just put the data from December 14 to this, right? Now line, data range it is asking us, so we are selecting this data range, and location range I have already given to him. And now marker color I want, so marker color I want black to be shown to me. Drag it till the end, so it will be showing me the line chart. Now copying one and saving the same and pasting it till the end. Again doing the same thing for rest of my ratios. It will be very easy to do. We just have to give our instructions. According to that only we can make our trend lines. Then if we want to calculate our mean for the data we have calculated, so again if error function, then we will be averaging out from our data and closing it. Now Control plus C and dragging it till the end. Again same, but it has taken this much data only. We have selected this data and Control plus C and dragging it till the end. Then selecting the data over here. Same thing we will be doing for our rest of our data. Now moving forward for our more datas like this, and this is done. Our mean is calculated. Now for median we will be doing like this, Control plus C and drag it till the end. Again do the same thing for this data. All the datas we just have to calculate once and we can just copy paste it to other datas too. So this is how our ratio analysis will be done for our Eicher Motors. So we have done our ratio analysis for our Eicher Motors. So profitability, it is stable margins but scope for improvement post 2020 is there. Growth, strong bounce back after pandemic signals robust demand recovery. Efficiency, negative cash cycle and high assets turnover, which means good operational strength. And cash flow, where strong cash conversion ratio and low dependence on debt is there. And return ratios, which means need improvement, ROE and ROCE trending below past highs. So what is the strategic use of this analysis? First is our investor communication, where it builds confidence by showcasing recovery trends and working capital efficiency. Operational strategy, which focus on improving return ratios by tightening asset utilization, cost control. Then is our capital allocation, where strong CFO allows us for reinvestment or increasing shareholder returns. And risk management, where it maintains or enhances negative CCC for continued liquidity advantage. So in conclusion, ratio analysis is an indispensable component of financial modeling, offering a structured and insightful way to evaluate a company's financial health, performance and potential. So by examining liquidity, profitability, leverage, efficiency and market ratios, businesses can uncover actionable insights that guide strategic decisions, attract investors and sustain growth. So whether we are building a financial modeling or mastering ratio analysis, equips us with the tools to access risk, identify opportunities and communicate financial stories effectively. As we have seen through the Veggie Foods example, ratio analysis not only builds confidence among stakeholders but also lays the foundation for strong financial planning and forecasting. So Thank you all for joining today's session. I hope it offered clarity and insight into the complexities and importance of financial modeling. So keep practicing, stay curious, and continue refining your analytical skills. If you have further questions or would like to explore this topic deeper, feel free to reach out or connect after the session. Until then, happy modeling and all the best in your professional journey.